The big market turnaround may be leaving some investors on edge, or maybe not, with the VIX at 14. The Dow, though, effectively traveling 700 points from its lows overnight into today's close. So how should you navigate these wild swings? Should you be more nervous than the market thinks? Joining us now is Canaccord Genuity's chief market strategist, Tony Dwyer. You were sitting patiently, Tony, listening to this conversation. My guess is you will say, no, there's not a real reason to be afraid right now.
So
don't put words in his mouth.
I'm in this really funny position.
Hold the notes.
You know, the big
got here a minute before the show started.
Don't give away our secrets here. All right, come on.
The big bald bull is usually the most bullish on the show, and the most, all year I've come here, or last year I come here, and to what we've been talking about before, Brian, the guys printing the money keep telling you they're going to print the money. And we keep trying to figure out if it's good or bad, right or wrong. It just is what it is. Now, to your point exactly, I feel like I'm the least bullish strategist out there right now. Everybody's ramping their targets to 3,500. Everybody's picking on the bears that are switching. The put-call ratios are historically high. The money movement into leverage funds, ETFs, is historic. The bullish ones is really rampant. I really I see about 5% upside. I also think that you could have a 5 to 10% correction just because it's up too much. There's too much euphoria and anticipation. The overall market, I would say, is up too much.
Why
the
too
S&P
much?
500. Because by too much, I don't think it's too much valuation-wise or fundamentally. Fundamentally, I think we can go a lot higher over time. But there's times in the marketplace where you don't need to chase the next tick. With a fundamental backdrop of credit and all the things that in the turn and the pivot in the global economy, there's no way you want to be negative, in my view. But there's times where you can just not chase the next tick. And if you wanted to buy, just wait for a little bit of a pullback, and we're in that zone.
So because I did read his notes, Brian, I read that, in fact, you're not concerned about the spread of junk over investment grade, which is around 175, and that you're probably more talking about a pause. But you mentioned valuations, and that actually is what worries me. I mean, positioning is what it is, but I think that can move pretty quickly. But I look at price to sales, I look at EV, EBITDA, and I certainly look at PE ratios, and I see us back to levels that I think we haven't seen since some of the most bubblicious times.
Well, when you look at the average multiple for the S&P 500 on operating earnings, it's at 19 times when core inflation is between 1% and 3%, which it's been since 1995, and then back into the 1960s, Timmy. So you don't even have to go back there to find a higher multiple than we're at today. From the third quarter of 2016 through the third quarter of 2018, you actually traded at 19 or higher. So actually where we are or higher. So, these targets that we put out are ridiculous, right? Because you're guessing at a point in time of what it should be. It should be 19 or higher. I'm at 20 times, which gets me my 34.40. Could I make it 21 times if I wanted to play the game? I just think it's the process that's important. And in October, early October, when I sat on the desk and it looked like the end of the world was coming and everything was rolling over on the trade war and it got too pessimistic, it was time to get in the game because the guys printing the money told you they're going to print the money.
But they're not going to print it forever. The Fed's balance sheet may not expand forever, but they may even start to reduce it.
Okay, this is going to be heresy. You ready for this?
Yeah.
Okay.
Yeah.
In a primary currency, you can print as much money as you want as long as you're the primary currency. So the idea that they can not do this, they're out of bullets, has clearly, by the expansion of the balance sheet, not been correct. So, I don't want to say whether it's good or bad, right or wrong. I'm not that smart. When they tell me what the game plan is, I don't need to be smarter than you. I have to listen.
Yeah, but they didn't tell you what the game plan was.
Yeah, they did.
They actually said it wasn't QE. I mean, that's the thing. Well, think about it. They said that it was a mid-cycle adjustment for the 3 consecutive rate cuts that started in July. But what happened with the balance sheet, they said was not QE, is not QE. Nothing to see here, all is well.
Dan, you're right, but it doesn't matter. Think about this. It doesn't matter if it's QE or not QE. It's money coming into the game. But I would take it back further. The dovish pivot in early January was the game changer. It was 1995 all over again when they went from tightening monetary policy to easing monetary policy in an administration that was under duress, right, which has an analog to now. And the market gripped it and ripped it, went up 34%, followed that up with a 20% year in 1996, almost 30% in 1990, or no, 30% in 1997, 20% in 19. We have to stop with this is all over. It can correct. I think we're going to have a correction. I'm just asking people to not chase the tape. But until you have excessive valuations, which, I don't think they are, Timmy, on the operating earnings basis, or all the money is coming in.
Because Microsoft and Alphabet, Facebook,
when
Good point.
Their earnings,
Good point.
their earnings
Good
don't
point.
care.
And they're
if
structurally
there's
lower
bombs
PEs.
over Baghdad.
That's true.
Or a credit event.
So here's the thing. Timmy asked
There's also
about the
lower
high yield
PEs.
debt.
Yeah.
The high yield debt market is really important. Would I go and buy high yield debt at this tight of spreads? Not a chance. But what it is telling us is that there's so much money available to companies to borrow. It's such a cheap interest rate. There's no way I should be able to buy the house I can buy but I can because interest rates are so low. Companies are the same way. What do they do with it? M&A, buybacks, the whole 9 yards. Equity-friendly things.
And Tony, and you know what turns a 5% drawdown into a 15% event is credit. And there's not a lot of evidence of a credit event going on right now. How does the dollar and rates factor into this drawdown? Is that a weaker dollar story or a stronger dollar story?
Chris, I love the dollar. It's never a positive for the market, right? Because when it's going in the favor of S&P companies, well, it's currency translation. It's not organic, doesn't matter. But when it's going to hurt the companies, oh, wow, the dollar's going to hurt. If you look at it, the dollar index is at the same place it was at the end of 2014, despite all the calls throughout that entire period of how much it was going to go
That's
up or
why,
down.
and by the way, good point. Tony Dwyer, that's why we haven't talked about the dollar index because it's been sitting there flat.
Right.
Like a calm sea. Tony Dwyer, great analysis, good discussion.
Thank you,
Appreciate
Brian.
the honesty and the candor.
Thank you.
S&P targets don't matter.
They never have, dude.
But what does matter, Guy Adami? I asked you that earlier, and you, another Mr. Honesty, you said, I don't know. And my point on everybody's buying the same 5 stocks vis-a-vis these ETFs like the triple Qs and whatever they are. Does Alphabet care if some ships get mined in the Strait of Hormuz?
Apparently not.
Apparently not.
So when, in terms of the downside, that was sort of my answer. I don't know what's going to take. I mean, you could have made a very cogent argument that last night was the start of something. Clearly, it's not. I don't know what the exogenous event is. I wish I was smart enough. I do think a weakening dollar could be that. I do think rates going back down could be that. I think the gold market goes up every single day, could be telling you something. But you know what? To Tony's earlier point, you know, the Fed's giving you the playbook. You just got to play by their rules.
All right. Good discussion, guys, in the macro markets.